The possibility of a big problem in the housing market called a real estate crash is making people worried. The problem is getting worse because mortgage rates, which are the costs of borrowing money to buy a house, keep going up. Every day it feels like the problem could get even worse, shaking up the economy even more. Keep watching as we tell you what's happening, especially how the changes in mortgage rates are pushing the housing market toward a big problem. One person has caused a lot of trouble for the housing market. The housing market is not doing well. Even though the mortgage rates, which are the rates you pay to borrow money for a house, are very high, the prices of houses keeps going up. This means that it's harder for people to buy homes or even to rent them. This situation is called nostalgia because it reminds some people of a difficult time in the past, like in the 1980s. Back then, there were also problems with the housing market.
We think it's a very serious situation. We think that people are not buying because they can't afford the average product on the market. The disparity between the median income and the median priced home is much too large, and it's growing.
But it got better eventually. Right now, many things are making it hard for people to buy or sell houses. For example, the mortgage rates are very high, but there aren't enough houses for sale. This makes it hard for people to afford to buy a home. There are some signs that things might get better soon. Experts think that the mortgage rates might go down, which could help more people buy houses, but we'll have to wait and see what happens. At the heart of the impending crisis lies the relentless ascent of mortgage rates, single-handedly wreaking havoc on the once buoyant housing market. Despite the highest mortgage rates in nearly 2 decades, home prices continue their relentless climb, defying economic logic and exacerbating the affordability crisis. The relentless march of mortgage rates has rendered home ownership an elusive dream for many, plunging the market into a state of turmoil not witnessed since the tumultuous 1980s. Affordability, or the lack thereof, emerges as a central theme in prices, and mortgage rates reveals a stark reality. With each passing day, a growing segment of the population finds itself priced out of the housing market, relegated to the periphery of homeownership aspirations. Against this backdrop of economic uncertainty, the Federal Reserve finds itself at a crossroads, grappling with the Herculean task of averting a catastrophic meltdown. The tightening monetary policy, characterized by a relentless series of interest rate hikes, seeks to rein in inflationary pressures but risks exacerbating the housing market turmoil. The delicate balancing act of Federal Reserve, navigating the treacherous waters of economic instability, underscores the fragility of the housing market ecosystem. The confluence of soaring mortgage rates, stagnant wage growth, and dwindling housing supply portends a perfect storm brewing on the horizon. The dearth of affordable housing options, coupled with the exodus of potential buyers from the market, paints a grim picture of an industry teetering on the brink of collapse. The ripple effects of a real estate crash would reverberate far beyond the confines of the housing market, sending shockwaves through the broader economy and plunging millions into financial turmoil. Amidst the mounting chorus of doom and gloom, glimmers of hope emerge on the horizon, offering a semblance of respite from the impending storm. The prospect of falling interest rates, heralding a potential reprieve for beleaguered homeowners, injects a sense of cautious optimism into an otherwise bleak landscape. The tantalizing possibility of a market correction, catalyzed by a precipitous decline in mortgage rates, offers a ray of hope for those ensnared in the throes of the affordability crisis. Yet, amidst the cacophony of economic prognostications, one immutable truth emerges. The housing market stands at a crossroads, teetering on the precipice of collapse. The trajectory of mortgage rates, intertwined with the broader economic landscape, holds the key to unlocking the mysteries of the impending crash. As policymakers grapple with the Herculean task of averting catastrophe, the fate of millions hangs in the balance, caught in the tumultuous currents of an uncertain future. Thanks to the persistently high average mortgage rates, which have remained more than double what they were in 2020 and 2021, and the soaring prices of homes, the housing market finds itself in a state of stagnation. This stagnancy is evidenced by the fact that existing home sales have plummeted to levels not seen since the peak of foreclosure crisis in 2010, while mortgage demand has dwindled to levels not witnessed in over 2 decades. Simultaneously, we find ourselves amidst an economically uncertain period. Household debt, primarily compromising mortgages, credit cards, and student loans, has surpassed a staggering $17 trillion. Compounding this, inflation persists above the Federal Reserve's 2% target rate, with the looming possibility of a recession looming over 2024. This leads to a pertinent question. Could the housing market be teetering on the edge of a crash? Forbes advisor sought insights from various housing experts regarding the trajectory of the housing market in the next 5 years. While the consensus suggests that the housing market may rebalance itself eventually, there are discernible warning signs indicating potential changes ahead. The Federal Reserve Bank of Dallas, in a 2022 report, identified indicators pointing to a burgeoning housing bubble in the United States. Although the sharp escalation in home prices doesn't singularly signify a bubble, the report underscores the importance of considering other fundamental factors. These encompass shifts in disposable income, credit cost, and accessibility, supply disruptions, and rising labor and construction material costs, among others. Len Kiefer, deputy chief economist at Freddie Mac, diverges from the notion of the U.S. housing market being in a bubble. He delineates a bubble by 3 defining characteristics: speculation-driven price growth, credit expansion fueling bubbles, and the eventual bursting of bubbles. In contrast, Kiefer attributes the record house price growth in 2021 to factors such as historically low mortgage rates and a fundamental shift in housing demand rather than speculation or credit expansion. Differences between the current housing market and the 2008 housing crash are notable, particularly concerning tightened lending standards post-crisis. This ensures that mortgage approvals today are less likely to default compared to pre-crisis standards. Additionally, the prevalence of fixed-rate mortgages now, as opposed to adjustable-rate mortgages prevalent before 2008, offers homeowners stability, shielding them from payment shocks. Furthermore, a significant proportion of homeowners today hold equity in their homes, a marked contrast to the negative equity prevalent during the 2008 crisis. This equity acts as a buffer against downturns, providing homeowners with financial resilience. Despite these distinctions, warning signals loom over the housing market's future trajectory. The amalgamation of soaring mortgage rates, inflated home values, and scarce inventory portends a challenging landscape for 2024. The Federal Reserve's efforts to combat inflation by raising interest rates have contributed to the surge in mortgage rates, exacerbating affordability concerns and restraining demand. A recession could exacerbate these challenges, leading to further downward pressure on home prices and increased inventory as more homeowners seek to sell to access their equity. However, the likelihood of a recession-induced housing market crash remains a subject of debate among economists. Looking ahead, experts anticipate a housing market reset following the recession, marked by declining mortgage rates and a resurgence in buyer demand. However, the acute housing supply shortage poses a persistent challenge, exacerbated by homeowners' reluctance to sell amidst low interest rates. This scenario points towards a potential shift in inventory dynamics in 2025 to 2026, contingent upon a decline in mortgage rates. Only time will tell whether the housing market emerges unscathed from the brink of disaster or succumbs to the relentless forces of economic upheaval. What are you anticipating with regards to the housing market? Make sure to leave your comments below and do not forget to like, share, and subscribe to our channel for more.